Thanks for joining us for this panel discussion on new methods and data for mortgage research and analytics. As Larry Cordell discussed in his opening remarks today, technological advances have allowed us to store and work with increasingly larger and more complicated data sets. Creative new data sets with low latency and more sophisticated modeling approaches have helped advance mortgage research and better inform policymaking and regulation. Today, we're joined by 4 experts who will tell us more about their work in this space. I'll introduce each of them and then give them time to do remarks for about 7 or 8 minutes. After each one has had the chance to speak, I'll pose some questions and then open it up for the audience. For those of you who are connected online, please feel free to go ahead and submit questions in the chat. If you'd like to unmute and ask your question directly, just enter your question in the chat and then raise your hand in Zoom, and we'll do our best to call on you during the Q&A. For those in the room, make sure, please, that your mics are on when you're asking your question. All right, so first we're going to hear from Neil Bhutta on enhancements to Home Mortgage Disclosure Act, or HMDA data. Neil is an economist at the Federal Reserve Board, where he's chief of the real estate finance section in the Division of Research and Statistics. Neil has published groundbreaking research on a number of topics in mortgage markets, including research on negative equity and mortgage default, the effect of interest rates on home equity extraction, and how the Community Reinvestment Act has impacted mortgage credit availability. And I'm thrilled to share that Neil will be moving to the Philadelphia Fed's Consumer Finance Institute later this year. We very much look forward to having him on our team. Next, Bob Avery will present. Bob is the project director of the National Mortgage Database, or NMDB, at the Federal Housing Finance Agency. The NMDB is an interagency effort to create and maintain the most comprehensive loan-level residential mortgage database in the U.S. to help address supervisory and policy concerns. Bob's going to tell us about the NMDB and related data products that his team has spearheaded, which have advanced the boundaries of analysis on mortgage originations and performance. Bob joined the FHFA after retiring from the Federal Reserve Board in 2012, and while at the board, he was one of the system's leading experts on HMDA data. He's the creator of the famed Avery HMDA lender file that has been used in many research studies, including those authored by a number of people in the audience today. So thank you to Bob for that. He himself has published extensively on mortgage lending, consumer credit scoring, and bank regulation. Andy Davidson will transition us to talking about advancements in mortgage modeling. Andy is the president and founder of Andrew Davidson and Company, a firm that develops and licenses prepayment and credit models and other tools for use by top mortgage lenders, insurers, and other groups in the industry. And in his team, they provide financial research and analytics, and they've been involved in the development of mortgage-backed securities products, housing policy, and credit risk transfer transactions. Andy has co-authored several books on mortgage performance and valuation, and has been a leading voice on policy topics such as GSE reform, testifying multiple times before the Senate Banking Committee. Finally, Giesecke will speak on mortgage modeling, specifically the use of deep learning. Kai is a professor of management science and engineering at Stanford. He directs Stanford's Advanced Financial Technologies Lab, as well as the Mathematical and Computational Finance program. Kai is a member of the Institute for Computational and Mathematical Engineering and serves on the governing board and scientific advisory board of the Consortium for Data Analytics and Risk. He's the founder, executive chairman, and chief scientist of Infima Technologies, a capital markets technology company building transformative prediction systems for those working in the fixed income market. He has published numerous articles in operations research, probability, and finance journals. So please welcome all of our panelists. So I will turn it over to Neil now to tell us about the HMDA data.
All right, thank you very much to the organizers for having us. This is my first in-person event in a while. I'm impressed to see so many people remember how to put on a tie. Okay, so I'm going to be talking about the expanded HMDA data. And again, these are my views, not necessarily those of the Fed. So I think a lot of people here know a lot about the HMDA data. Does this thing work? No. Okay. Do I have to press anything on this? Or?
It's not working.
Yeah, okay. So a lot of people know a lot about the HMDA data, more than I do, but I'll do my best. So just to sort of give some basics in background, HMDA is the Home Mortgage Disclosure Act, and it requires mortgage lenders to report details on every mortgage application they get every year. So I think there's like three big things that make the HMDA data unique. One is that it's got borrower demographics, race, ethnicity, gender, and income. Another thing is it's at the application level, so we see, whether an application was actually accepted or rejected. And then you also see the actual lender identity. So which lenders are taking applications and making those decisions. And so these data remarkably, one of the coolest things is that they're, made available to the public. And the goal is to allow the public to monitor whether lenders are meeting community credit needs. So in 2018, well, starting with the 2018 data, CFPB expanded the HMDA data collection. So what was expanded? They added a bunch of new variables, so over 25 new variables. They also enhanced some of the existing variables. And then now there's mandatory reporting of HELOCs. Also note that not all the changes were expansionary, so some small lenders no longer have to report data, and there's no more reporting of unsecured home improvement loans. So let me just talk a little bit about the key changes in HMDA. So first, in terms of the enhancements to some of the variables, so you have this is not exhaustive, but these are sort of things that that strike me as quite useful as a researcher. So loan purpose now includes an indicator for being cash out refinance or not. For non-owner occupied loans, we can now see whether it's for an investment property versus a second home. The race and ethnicity categories have been expanded. And then the new variables, there's a ton of new variables. So a lot more about loan conditions, so the term of the loan, whether it's an ARM or not, whether there's a prepayment penalty, any non-amortizing features. Demographic data has been expanded a little bit, so we know the age of the applicant. A little bit more about the lending process in the data, so a little bit more about the origination channel, so whether it's gone through a broker or not, that kind of thing. And then another interesting thing is there's a loan officer ID in the data. Now this isn't available to the public, but people with the restricted data, people with access to the restricted data have started to use this to do some interesting research. And then there's a lot more information about credit characteristics. So credit score, results from automated underwriting systems, DTI, LTV, and then a whole bunch of new pricing data. So not just interest rate, but a lot of information about upfront fees. And this came up in the last panel, how expensive loans have become. Okay, so who reports data? Thousands of lenders across the U.S. are reporting data, both depositories and non-banks. So I don't know if you can see the numbers very clearly, but in 2019, about 5,500 lenders reported data. And then, at the bottom of the second to last row, about 2,000 of those lenders are pretty small, so originated less than 100 loans in 2019. But starting in 2020, a lot of those lenders disappear from the data because they are no longer required to report. That has some implications depending on the kind of research you're doing, but from an aggregate perspective, it doesn't have a huge effect on the coverage of HMDA data. So, we still think HMDA covers nearly the universe of mortgages. So this is just sort of a time series of HMDA originations over the last, since 2004. You can see that big jump in originations in 2020, particularly from refinance originations. So about 13 million originations reported in the HMDA data in 2020. Like I said, we know which specific lenders are making loans. So this is just a list of the top 10. You can see Quicken is the biggest lender. But amongst the top 10, there's both non-banks and banks. And what's incredible is so for every lender we can see just a ton of details about what all these lenders are doing. Now, like I said, one of the key goals of HMDA data is to allow the public to monitor whether lenders are making credit available across the community. So I just wanted to show this sort of recent Bloomberg article that came out that was very critical of Wells Fargo. So they looked at the HMDA data and they found that there's a huge disparity at Wells Fargo in denial rates between Black applicants and white applicants. So, and that's what you can see in this graph, a much bigger disparity compared to other lenders. Now, they also noted, that in the article, the banking industry has long argued that credit scores rather than race explain any disparities, but it has lobbied against the release of federal mortgage data containing those scores. So this just takes me to my next slide, just to talk a little bit about some of the limitations with HMDA. And I think, it's an interesting question that we can talk about here. The public data still is missing some key information like credit scores, application dates. And I think, it might be an interesting conversation for this group to have about, the costs and benefits of withholding that information. But even aside from those limitations, even in the confidential data, there are some things that are missing to be aware of. So private mortgage insurance information, we don't know whether a loan has PMI and how much it costs. Loan performance is not in the data. Now, this is something Bob will talk about. So in the NMDB is solving this problem to some extent. I would love to see if there was a person ID to link applicants across time and across lenders. And then there are still some issues with the pricing information. So lender credits is an important variable if you're looking at upfront costs. But it is missing in instances when lenders are paying for specific closing costs. This is one thing that I've noticed in the data. I had an example, which I'll skip in the interest of time. I do think, the pricing information in the HMDA data is a really exciting feature to me of the data, especially the upfront fees. But just a sort of caution to people who might be using the data that they aren't quite perfect, at least just yet. So I'll leave it there. One last thing I'll say is there's some great resources at the CFPB, also on the FFIEC website, if you want to learn more about the HMDA data.
Well, I'll start and give a disclaimer. These are going to be my views, not the views of the Federal Reserve System or the Fed or FHFA or any other government agency, or for CFPB, we have to say for the United States. So, and this click will work. So my name is Bob Avery. What I want to do is talk about project that Neil mentioned, the National Mortgage Database. This actually had its genesis here at the Philly Fed conference in 2009. Right after the crisis, there were a group of people here who said, what data do we need? What didn't we have in the crisis? And this is one of the things that came out of that, and it actually proved successful. It's jointly funded. It's another example, Ed, of good government. It is jointly funded by the CFPB and the FHFA. So neither each pays half. We don't duplicate effort. We also allow any federal employee to use the data, the raw data, or member of the Federal Reserve System. So it's a way of expanding as much as we can. We're also now in the business of trying to put out aggregates and trying to reach as many people as we can. So what is the database? What makes it a little bit different, it's based on the credit bureaus. So it's drawn from Experian. It's a 1 in 20 sample of people of any mortgage that has been reported to a credit bureau since 1998. It's been active during that period of time. And we blow it up and it looks roughly like that percentage is accurate. What we do that's different is the credit bureau data, normal servicing data, missing a lot of stuff. What we have done is have partnerships with FHA, VA, RHS, Freddie, and Fannie, and we merge behind a firewall using name, address, social security number with each of those sources into our data file. We also merge in HMDA data using the proprietary data that Neil is talking about. We merge into McDash, we merge into the CoreLogic LP database, and we also purchase the entire CoreLogic property database, which sits behind a firewall at Experian. So we can merge, once we have a property address for the loan, we can merge it to that. We have FEMA data, which will eventually probably be incorporated, as well as MLS and Ginnie Mae, all of which are kind of waiting for us to get around to them. So it's very comprehensive, and that is really the spirit of the database. It's meant to be representative of the whole marketplace. There are about 5,000 servicers, which makes it very different than if you look at something like McDash, which is very concentrated. Certain markets are very concentrated. For FHA, it's a very concentrated servicing business. But for a lot of other smaller mortgage loans, it's the opposite. So you need this coverage over the smaller servicers. We produce now regularly every quarter. We take and add a new replenish with new mortgage, 1 out of 20 new mortgages reported to Experian. We have a total of 14 million mortgages now that we've tracked, and that's roughly out of 280 we believe existed. We have two databases. We track mortgages, but we also track people. You can take the sampling we did. So we do what Neil was just talking about. We have a beta database that we're working with, starting with anyone who entered the mortgage market post-2012, and we follow them to the present through every mortgage that they have, and it's done continuously so you can track that person. We also run 2 surveys that are drawn out of the NMDB database. Every quarter, we send a mail survey to about 6,000 parties that just got reported mortgage, and then every year we've done a survey of mortgages in distress, and I'll talk in a little bit more detail about that in a second. Let me talk, this is just showing the coverage, and we kind of just beat out HMDA, but Larry, we do a lot better than McDash. If you look, that's the lowest line there is McDash. And we're doing better as servicing shifts to non-banks and becomes more granular. NMDB picks that up because we pick up anyone reporting to a credit bureau. General patterns are the same. So let me talk about this is really to whet the appetite of the public. We're just now getting into the business of putting out aggregates. And we do have low latency data. We will draw an archive this coming Saturday, and that will take a snapshot of all active mortgages in our database. If you just pulled an aggregate credit report of everybody in our database, what is the report of the performance on their mortgage as well as every other credit obligation they have? That snapshot will be available to us at FHFA within a week, and we could put out a data series on that within a day of getting it. So that's about 10 days after the snapshot. What we're doing now is putting out monthly performance data. But we want to expand that. We're putting out we encourage people to go look at what we're putting out. These are tables. They're just the beginning. What we're looking for is for people to come back to us and say, we like this table, but we would like you to do X, we'd like you to do Y. We have performance. We also look at originations. And one of the things that I think is very useful is to look at outstandings. So that allows us to look at, well, what's the book of business right now? What are the outstandings? We can look, for example, at credit scores, and we can look at the credit scores of new originations. What we can give you is, if you looked at the entire book of business for Freddie Mac, what has happened to credit scores of outstanding mortgages each period, contemporaneous credit scores. And they paint potentially a very different picture than if you just look at the marginal new loans. So it's a different way of looking at the marketplace. We also allow you to look at coverage of the GSEs, but also the government programs and the non-government, the other, if you wish. So please, there's a link there. Go look at it. Tell us all of the things that we should be doing or not. Email me if you want, but we want to see how we can do better. We're ultimately going to have a cube that you can query various things. Go down a menu and query, give me how many loans were originated in the first quarter of 2007 in California. That's the objective. All right, 2 additional things. We do this survey quarterly. That is a public use database. It has all of the bunch of expectations and demographics about the people, as well as performance and all the origination data on the loan. The thing that's missing is geography. That makes it possible to release the public use database, but you strip it out all geography, but you have all the other things. We release about once a year. We're going to have an update. That update will include performance through April 2022. It will also include forbearance. It's going to allow you to look at who went into forbearance, who was still in forbearance, who refied, and what was a disposition, coupled with a whole bunch of stuff about attitudes, expectations, appetite for risk, and demographics about the people. It's a representative sample of anyone who got a mortgage since 2013. Site is there, download it, use the data, and again, tell us what's missing besides geography. We know that's missing. Okay, let me tell you the last thing. There's been a lot of discussion about forbearance. We estimate about 5 million people went into forbearance or had some sort of delinquency out of 50 million mortgages if we go back to 2020, March 2020 through last fall. About 5 million total people. What we've done is 2 surveys of that group of people. We did the first survey last fall and into the spring. We identified people either in forbearance who had a delinquency in the first 6 months of COVID, asked them a bunch of questions. Did you lose your job, et cetera, various economic events, demographics. And then what we do is we couple that data set with the performance, subsequent performance. So again, we will release a public use. It's in privacy review. We tend to release this within next month or 2. It will include performance through 2022. You can see what has happened to them. We will release further going forward in the future. We'll probably update it with future performance. We're doing a new survey, 2 seconds, right now in 2022. We're essentially going to go back to the same type of person, but these would be people who stayed in the market to November. They still had a loan, so they stuck it out through the crisis. Now they've gone out of forbearance. We're going to track what happens to them. We're going to catch them right now. How do they interact with their servicer? What's happened in their economic life? That will eventually become a database which allows all of you to do ex post research, as Susan talked about. This is a great natural experiment. We tried forbearance. This data set's going to allow you to look into those people who took it out and see what happened to them. And we hope will be a great benefit to all of you in doing research in the future. So let me stop there.
I've entitled this talk Meandering S-Curves, but after listening to Larry's talk, and then also the book I was reading on my way up here was this book about the writer Borges, the Argentinian writer, and this guy Hernan Diaz, who just has a book, just came out about like wealth, a fiction book, but this is a nonfiction book called Between History and Eternity. And I actually think that would be a better title for this talk. Because really what I want to talk about is long-term prepayment modeling. And so focus really on models that are used for valuation and risk. And for valuation and risk, we need to look out at least a few years. So most of the value from risk comes like the 3 to 5 year sort of average prepayment speed and how it's correlated to interest rates or other drivers of value. But on the other hand, we're getting all this like new short-term, low latency information. The question is, how should we be using that information to update our long-term forecasts? And so to me, this is a challenge for us as modelers, but I really want to have this subject today as a challenge to regulators, because whatever we want to do as modelers needs to be reflected in what financial institutions can do based on regulation. So first, the facts. They're sad. This is the prepayment rate, single monthly mortality, using a payment ratio, which is one of the measures of incentive that we use. over different years. So this is by as of year. And, it's a messy spaghetti. So I'll simplify it a little bit in one dimension. So this is just 2003, 2010, 15, and 2020. This is what the prepayment rate was as a function of incentive. So you can see it varies from almost no change in prepayments to a pretty dramatic change in prepayments by incentive. Now, there's definitely different measures of incentive that you could use, but pretty much no matter what method you use or how you measure incentive, we're going to see some variation of this sort. The next slide gives us a little sense of like the time variation of these numbers. So, prior to the financial crisis, we had, pretty robust response to interest rate changes in terms of refinancing. That went to almost zero for a while, so rose and fell. And then actually over the last few years, while people are saying, oh, how dramatic prepayments are now, they're still, from my perspective, looking back, 25, 30 years, are still pretty slow in terms of the response to interest rate changes. So the question is like, what are we supposed to do as a modeler with this, right? So, it's not so hard to forecast what prepayments are going to be next month, knowing what they are this month, because the trends sort of continue. But in order to value securities, we really need to look out 3 to 5 years. And so should we be changing our forecast directly as these things change or not at all? And then on top of that, the compounding problem is that in order to use models, we have a regulatory process that requires that all models go through validation. And so we develop a model, we validate it, we take some time, we put it out, then it's got to get into the systems our clients are using. And then after that, they need to have it validated themselves, and then they need to sort of check with their regulators to make sure they've gone through an appropriate validation process. So from the time that we think there's been a change, well, there has been a change in prepayment behavior, till we record it, until it shows up in the client's risk analysis, can be several years. And we can see from this chart that that's sort of on the order of magnitude of the cycles that we're dealing with. So what we think really is that we need some methods to address this, what we call the meandering S-curve. So I've sort of outlined 4 basic types of methods here. There's really, plenty more. We can get into each of them in extensive detail, but I really just want to give you a flavor of the ideas that are being used. So first, there's analyst judgment. So we can tune or refit models, sometimes with date or vintage dependent effects. We can go and change a parameter. Like, for example, if foreclosure is no longer allowed, it's pretty easy. We can just change the model to not allow foreclosure, and then loans are going to build up in some delinquent state. Or, for example, there was HARP, and HARP only affected a set group of loans. We could go in and sort of make some changes and say, this is what we think that effect would be. Then there's new date or vintage dependent effects. And there's various things we can look at for that. That's sort of the modeler's ideal. Oh yeah, we can just model it. There has to be some reason. And if we just get all of the reasons, then we'll have a model that adjusts over time. The problem is that we never know the next reason until afterwards. And so, we're sort of always a little behind. The third would be sort of just do Bayesian updating of certain parameters and sort of have a mechanical updates and, there's certain ways controlling the way the model is updated. You can have the effects fade out over time, or we can have AI-based solutions. And you can either have a fully AI model with multiple time-dependent variables, or we can have some reduced form. So I'll give you a little more flavor of each of these approaches. So the analyst judgment. So, we like analyst judgment because we're analysts and we've spent a lot of time studying these things. But, on the other hand, it's sort of time consuming. But one point to point out is like, there's a real problem. So the left chart shows the model, the top 2 lines is the actual versus the updated model, while the bottom line is the old model. And you can see that the old model worked really well for a while, and now the new model works better. Additional time-dependent variables. The biggest problem is that we're going to create a proxy for something that happened, and that proxy isn't what happened. And then the other portion that I mentioned, that we don't know the new effect until it happens. But even more importantly for valuation, anything that's in the model that's valuation, we need to forecast as part of our valuation system. And so if we have 30 time-dependent variables, now we have to forecast 30 time-dependent variables in order to value a security. The Bayesian updating's nice. It's automatic. It works. We have sort of two main problems here. One is regulators aren't really into this idea quite yet. Maybe it would be good if we could get some of that. And there's no explanation for why it happens. It just happens. But it is very consistent with the theoretical framework that we operate in, which is that we believe that prepayments are basically uncertain and that investors require compensation for that uncertainty. Here's an example, skip over that. And then the final is AI-based approaches, which are, very nice. They work quite well, but, they're not as good at explaining things. Once again, we have this regulatory issue. And then the biggest issue to me is that it's very hard to do valuation with them if I include many variables. And I don't know how to do sensitivity analysis because I don't know where the parameters are to change something that's happened in the economy, which I can do directly in a model that we've created. But we do have a tool to look at these. These are just two different time periods, and it shows that, depending on the time period you chose, a model might work, the Bayesian model might work. Different time periods, different models have worked. So anyway, to wrap up, we have these 4 different approaches. There's probably more. And then you probably really need to use all of them, to some extent. But we're really working on this from a modeling standpoint, but we really need the regulatory community to sort of join in with us and say, well, how can we incorporate these approaches into how firms are regulated? Thank you.
Thanks very much for having me in this panel and allowing me to join remotely here. So I'm going to be talking about the application of AI methods that Andy just briefly mentioned for the purposes of prepayment prediction. It's clear that AI is playing a very large role. It's transforming many applications in different industries, and the financial services industry is no exception in this regard. There's one particular technique called deep learning or deep neural networks that has been particularly prominent in many applications. It's underpinning many of the best performing AI systems that we tend to use on an everyday basis. For example, speech recognition on smartphones and automatic translation. All of these gadgets are actually driven by deep learning. And I want to make the case here in this short presentation that there's a very compelling role for deep learning to play when it comes to prepayment prediction. It achieves an amazing performance on an absolute as well as a relative basis. So before really showing you some of the results, I wanted to take a step back and perhaps just look at the factors that play a role here, where deep learning can really bring out its advantages, right? So Bob has talked about a lot of the data that's actually available in mortgage markets. It's a very data-rich environment. And with these machine learning technologies, especially deep learning, which is very scalable computationally, we have the ability to actually harness all the available granular loan-level data. So we're here talking about 100 million plus borrowers, 20 plus years of monthly data. We have observations on all the actions that borrowers take. Full prepayment, curtailment, all forms of delinquencies, loan modification, forbearance. All of these events are being observed on a monthly basis. There's a lot of alternative data out there at the account, at the borrower level, from the credit bureaus and other sources, and all that data can be efficiently processed and ingested into these machine learning algorithms, and the data can be used to make predictions. The ability to really suck in all of this data is very much different from more conventional forecasting approaches that have been in use in the industry and in academia for decades. They tend to be based on small samples of that data, just tens of thousands of loans, maybe hundreds of thousands of loans. So they tend to ignore a lot of information, a lot of data that's actually available. Having access to all of that data means that we can look at a broad range of potential explanatory variables at the loan level, at the macroeconomic level, and so on. So we can, with these approaches, really go beyond the small set of factors that people have looked at traditionally. And contrary to what was actually said on this panel, these approaches are fully transparent. So there's been a lot of research in academia as well as in industry on shedding light on the behavior of these systems, opening up the black box. There's rigorous statistical approaches that supply significance tests. We have p-values for the variables and a range of other more traditional statistical tools available to really understand and interpret the role of the variables that go into these models. And really where deep learning and other technologies, machine learning technologies can shine is that they have the capacity to capture and encode fully nonlinear behavior that's really present in borrower behavior. So this is really going beyond the S-curves that we've seen previously. There's a lot more nonlinearity in the data that's hidden, that's not visible to the naked eye. And given the scale of the data, it's really impossible for the analyst to really understand all the relationships that exist in the data. And not only that, with deep learning, deep neural networks, we have statistical guarantees in the form of the universal approximation property of these tools that with enough data, we really are guaranteed to be able to encode all of these nonlinearities that exist in the data. And as a result of that, these tools really do achieve unprecedented predictive performance. They're able to uncover these hidden patterns, hidden stable patterns in borrower behavior, and that really is the source of the outperformance versus more traditional, conventional statistical approaches that have been around for many decades. And just to give you a high-level sense of the degree of performance that we can achieve here versus legacy approaches, here in this graphic on the left, we're looking at the ratio of actual or predicted 1 month ahead CPR. So that's the conditional prepayment rate annualized for a very broad range of mortgage-backed securities, agency mortgage-backed securities, 30-year UMBS with vintages between 2013 and 2021. We're looking back over an especially interesting time period here that starts in January of 2019 and ends in July of 2021. So it does cover the pandemic, which was specifically challenging for prepayment modeling due to the fairly extreme macroeconomic circumstances that prevailed during this time period. So since we're looking at actual predicted, the ideal, the perfect prediction has a ratio of 1.0, right? So this is this horizontal white line here. And the pool level predictions here that we're getting using this deep learning technology really gives us very low error rates of under 2% on average. So we are confident that there's no biases here. There's just variance in the predictions. Now, if you compare that with two legacy approaches, and these are very widely used legacy approaches, trillions of funds in mortgage-backed securities markets are managed using these legacy approaches, then the picture is very different, right? There's systematic bias. On average, here for this red approach here is 23%. So it's a full order of magnitude larger than what we achieved with these AI-based approaches. And there's even another one out there also very widely used where the error rate is on the order of 50%. So it's a significant a gap between conventional versus deep learning-based approaches. And I should say that this is fully out of sample. So the deep learning model that was used to generate the predictions here was frozen as of December of 2018. So it has not seen and has not had the benefit of having seen data during the pandemic, yet it produced very, very meaningful forecasts throughout this very challenging period. Now, what's the benefit of this is obviously that allows you to perform superior security selection and construct superior MBS portfolios. Now, the same data just spread out in a time series so that you see where the numbers actually come from. Very significant errors here of legacy approaches during the pandemic, whereas the AI-based approach really performs very well throughout this entire period. There's no really significant increases in errors during this period. So very robust performance across the different macroeconomic environments that we've seen during this time period. And again, the model has not seen any data during this time period, right? It was frozen back in December of 2018. The other models were updated on a frequent basis during this period. So the performance that we actually see for these other approaches is fairly optimistic, since they did have the benefit of hindsight. They were able to update their models. We didn't do that, just to get a very conservative view here on predictive performance. Now, if you look at the last 6 months of actual versus predicted for broad coupon vintage cohorts, again, 30-year UMBS, Fannie Freddie securities, thousands of MBS go into this. Very, very good performance through time as well. So it's not just the pandemic period where we saw this performance. Actual predicted ratio average is close to 1, so no bias at all, just variance. Now, what are the takeaways? Just quickly, deep learning is very promising, provides unprecedented predictive accuracy for prepayment, and more broadly, other forms of interest, delinquencies, et cetera, and that delivers superior security selection, portfolio construction, and risk management. I focused a little bit in these charts on short-term prediction, which is challenging. It's not trivial, as we've seen legacy approaches that have been around for decades have had a hard time really just predicting 1 month ahead during more challenging periods. So it is not a trivial problem, even at the short term. Longer term, it becomes even more difficult. Obviously, there's the whole macroeconomy that needs to be projected forward in order to make a prediction about borrower behavior. There's also, of course, a lot more advanced analytics that sits on top of these prepayment forecasts, these CPR term structures, option adjusted spread, and many others benefit from more accurate CPR projections. We've done work that's more focused on credit risk transfer, where credit obviously is the more relevant component. And we've shown that this technology also works well in the non-agency domain. In fact, we've worked with the CoreLogic market a database that Bob mentioned earlier. So throughout these different types of loans, throughout different time periods and macroeconomic regimes, these technologies do seem to perform very well and certainly do significantly better than more traditional, conventional statistical methodologies. So there's a lot of work that we've done in this regard. If you're interested, please reach out. Be happy to further engage and share some materials that provide details.
Thanks a lot, Kai. So since we're running a little bit behind time, I'm just going to go ahead and open it up to the audience for questions rather than ask mine. I see Larry Cordell has one ready to go. So Larry?
Okay, I actually have a couple questions, one for Bob and one for Kay. So Bob, you said you're leaving out geography in there. I mean, are you aware that, the SEC looked at this, for the Reg AB2 and determined including the state and the 2-digit zip code was enough to anonymize the data? And I just wanted to say that. Question to Kay is, I guess one of the issues with these, there's two issues with this research about, and it goes back to the old neural nets, is this massive overfitting based upon the data that you have. But as like Andy pointed out, the most useful models are ones that look out 3 to 5 years, because that's the length of time of the typical the typical mortgage-backed secured, the weighted average life. But if you put in these large number of variables, then you have to forecast, and I think you pointed that out as well. So, I want to make a pitch for Occam's razor here, that maybe we might want to think a little bit about that as well.
Let me just answer you quickly. We're a federal agency. Freddie and Fannie can make business decisions about what they release for investors. They can make them sign things. I can't violate the law. I cannot release mortgage loans that it's easy for me to re-identify the people. So we can't do that. We run a serious privacy risk assessment as required to by law. Census helped us with that. We determined that we actually have to redact some variables because of privacy, some obscure racial categories. There might be one person in Bhutta. Now I can identify that person. Now I know their census tract. I can figure out who they are from the deed title record. So we will work out accommodations. Our objective is to get people using our data, but by redacting all the geography, that's the one thing we're missing. And we hope that the other things allow you to look at the richness. The natural experiment that Susan was talking about, most of the people that went into forbearance, virtually every one of them that went into forbearance and stuck it out through at least the first 6 months, had something really bad happen to them. They lost their job, they had they got sick, they had major expenses. It was not a holiday. Those people, those 5 million people, how did it ultimately work out? Was subsidizing them, providing this means of getting through that period, did that turn out to be successful? So we hope, I don't think you need geography to look at that. Our hope is that's what we want to offer you people by giving you all the other richness about them, just leaving out geography. That's the trade-off. For you, though, maybe we'll give you geography, Larry.
And before we go on, we'll give Kai the chance to respond to Larry.
Yeah. Thank you for the two questions, Larry. So on the topic of overfitting, right? So I mentioned some of the numbers, right? So there's 100 million plus individual borrowers that are covered by, data sets that are out in the public domain or can be licensed. The agencies put out extensive data sets, CoreLogic licenses other data, right? So there's more than 100 million individual borrowers. If you chop that up, the data up into like monthly periods over 20 years, you get a billion plus individual loan month samples. So that's a fairly nice data cloud to even fit larger models, richer non-parametric models. And the ratio of data to parameters is still very meaningful, so that you don't get into overfitting issues. So that's an issue that we studied extensively, and we're confident that there's no overfitting. And the results that I showed, the out-of-sample results that I showed, demonstrate that these models do generalize very well on an out-of-sample, out-of-time basis. So that is indicating that there's no overfitting really present. The other thing is we have the tools, rigorous statistical significance test, to look under the hood and see what the influence is of these various individual variables that we're using as predictors, as explanatory factors. And so the relationships that the neural network is identifying all make perfect economic and financial sense. So for example, without telling the neural net that there's an S-curve relationship, it will automatically identify a family of S-curve type relationships that are perfectly smooth and really conforming to the economic intuition and to the data, to the underlying data, right? And that the same type of observation is for many other nonlinear relationships that we see in the data. So there's a lot of evidence here that there's no overfitting in this approach. So the second comment was with regards to long-term predictions. So I've shown you 1 month ahead predictive performance. We can produce 30-year forecasts with this approach, and these long-term forecasts do inherit the advantages of the short-term forecasts, because the long-term forecasts are built out of a sequence of short-term forecasts in a consistent manner. And so to the extent that you have a perfect foresight with regards to the macroeconomy, you still get the best performing conditional forecasts of prepayment and credit behavior, right? So that's the thing here. Conditioning on the realized macroeconomic scenario, you still get the best performing forecasts out of these tools. So, of course, we cannot remove the macroeconomic uncertainty. No one can, right? But that's outside the scope of these types of models. There's two problems here. One is forecasting where the macroeconomy goes, and the other one is, given the macroeconomic scenario, what are borrowers going to do going forward, right? And we only look at the second problem, producing conditional forecasts. And that will be my response.
Thank you. So I think we have time for 2 more questions. I do want to get one in from the online participants, and then have one more from our in-person audience. So the one I'm going to choose is for Andy. For traditional data-driven model development, validation seems to be a useful process for increasing confidence in the model. Granting the analyst judgment contains information and could improve models, is there a process for reviewing it comparable to validation for traditional models? Could you talk about that?
Can you repeat? I'm not sure which model they're talking about. So can you just repeat that?
Well, sure. So how would you basically validate analyst judgment? How do you think about, that's provides a lot of informational content and value?
Yeah, so, to me, validating analyst judgment, so I guess the question is, if you have models that are updated based on analyst judgment, because obviously once you have a model, the model exists, right? So it doesn't really matter how you created the model, you can then validate the model based on its actual performance. And so whether it was an AI model or a analyst model, whether or not it's like a bunch of equations just someone thought up right at that minute, or they use some complex statistical technique, once you have the model, the validation basically proceeds in the same way. And for us, validation is cross-sectional validation, longitudinal validation, and sort of validation versus sort of market prices, and whether or not it's sort of useful for the purposes that it's going to be used. And so even if you have an analyst updating something, you can sort of still pretty readily go through a validation process to say, have you improved on those benchmarks? And so what we really need is when we adopt a model, also adopt a validation process for updates. And so we would say, like, these are the way this model can be updated. And like if it's Bayesian, then it will just be updated when there's new data comes in. And I still think no matter how you've updated a model, you shouldn't start using it instantaneously. There should always be a validation process in between when a new equation is created and it's used for a business decision. But we have to get out of the idea that validation is like a separate process that takes place over the course of 6 months. Validation should be part of the update process and part of the model acceptance process.
Thanks. So we have one more question. Steve, you've been patient.
So there is a real difference.
Oh, could you turn your mic? Thanks.
There's a real difference in the story that Kai and Andrew are telling, right? Andrew is telling a world where talking about a world where the underlying parameters are changing over time, right? And if the underlying parameters are changing over time, you're always trying to race to change the model to catch up with those changes that happened. But Kai is showing us data that seems to suggest that at least for prepayment, this underlying model was extraordinarily stable because he could use data from 2018 and earlier, create a predictive model, and simply use the changes in all the variables that are going into the input and get very high predictiveness. And that sort of suggests actually that during the pandemic, the underlying model didn't change, that the underlying model was very, very stable over this long period of time, and the pandemic didn't change it. And I'd just like to get both of your thoughts on that sort of different view.
Yeah, so I guess, our view is that what motivates borrowers is relatively stable over time. But the situations that they face change over time. And that we've tried to create models that use as many cross-sectional variables as you want. As a matter of fact, like my view is that AI is a better way of doing cross-sectional analysis than anything else. But that's what credit scores are. Essentially use a large amount of cross-sectional data. But that when you start to get to the long-term economic variables, we really want to use very few, right? So we want to use just like a few interest rates and a house price and like maybe unemployment and not really much more. And those relationships are the ones that if we limit ourselves to those variables, we find that things aren't that stable. And I don't know, maybe they've found a different approach. Our use of the AI models shows that they work really well during some time period. So our AI model that I showed worked really well during that time period, but it worked really poorly in the transition from 2005 to 2007. But why should anything work during that time period?
Right. So my 2 cents. I agree with what Andy just said. Right. There does seem to be a stable pattern in borrower behavior. Right. So obviously the economic circumstances do change over longer time periods, but borrower behavior is very robust, is very stable, and this is what's being extracted from the data using this deep learning technology. It is true that that there can be some variability, and the reason we strongly believe that this technology actually works so well during the pandemic is that the pandemic wasn't actually that unusual. If you look back, there's periods that were not unlike the pandemic. For example, if you look at Hurricane Katrina down in the South, you did have spikes in unemployment rates all the way up to 20% and more. And so conditions of the type that were observed during the pandemic were observed earlier in different circumstances. And because we're not throwing away any data, we in fact use all the data that is available. The model is able to learn from these past episodes and extract meaningful insights into borrower behavior from these episodes. And this learning the model does is flowing into predictions, and yes, it seems like the model has picked up how people have behaved in similar circumstances, and that's reflected in the performance that we see during the pandemic.
All right, well, with that, we should conclude. So please join me in thanking our 4 panelists. And now I'll turn it over to James Vickery to give us some closing remarks.
So I don't have too much to say. Thank you very much for your participation today. Particular thanks to Larry and to the panelists and moderators for 2 great panels. So we'll see, the day 2 of the conference is tomorrow. It kicks off at 9:10 in the morning. So we hope to see you all there. So let's go to sort of shift gears a little bit to talk about academic research. We have 8 great papers, each with a fantastic discussant. So we look forward to seeing you both online and in person.